Hi, good afternoon to all. A very warm welcome to my fellow panelists and the audience out there. I think Aishwarya has already set the context of the discussion, the session that we are going to do today. So we will be discussing about how to build a resilient portfolio for continued wealth creation. So let's get this started, with a thought that I have in my mind, which goes as that we all live in very unique times where both great opportunities and extreme challenges coexist. And that's the exact thought on the minds of every equity investor as to how to build one of the most resilient portfolios, which navigates well during the tough, turbulent times, during the challenging times, and at the same time help them earn superior risk-adjusted return in long run. Let's do a quick recap and understand the past trends in the market over the last 18-20 months. The returns were fairly low and subdued, and this was largely because of the global instability. We were in the rising interest rate scenarios. We had the inflation looming. However, over the last few weeks, in last one quarter, last few weeks, we did see markets bringing back the cheer and the spark in the eyes of every equity investor. So with that, I open up this session by asking the first question, starting with you, Manish. With that, are we right in assuming that Indian markets have sailed through the recessionary fears and are now showing the signs of the next bull run? Or can we expect some more volatility over the next few quarters or months? Starting with you, Manish.
Thank you, Ritika, for this bringing this very interesting point. And first thing is that there's no recessionary trend in India. So I don't want to confuse audience by giving them some inclination that there is a recession in India. India is growing very well. And technically, the recession definition is 2 quarters of negative GDP growth rate. So we are doing very well as an economy. And yes, there are 17 countries which have seen a negative GDP growth rate in the month of March. There would be close to 23 countries in the world which has seen a 2 quarter of GDP degrowth. Till the March, the June numbers are not out, and maybe 28 countries which have seen the 0 to 1% growth rate. So what we have today is India is doing phenomenally well, and there's a lot of capital which is flowing in India. And having said that, the volatility is the nature of the equity market. You can't be with the equity market without the volatility. And market has been an uptrend, and uptrend is not a volatility. Last 2 years, market did took a pause because of the COVID-related conditions. But this was just a phase of consolidation. When you look at equity market, you are looking at a trend of 8-10 years or so. You're not looking at a 1 quarter or a couple of quarters even. So anyone who's investing in equity is with the long duration horizon. And with all the paraphernalia around the world, India remains one of the most interesting markets to get invested in. The markets are deepening enough with the privatization, with all the things what government has done in the last couple of years together. So to me, it is a very sweet, opportune time where the micro positives on the micro side for the last half a decade or so are meeting with the tailwinds on the macro side. So this is going to be a very interesting time for the Indian markets for next half a decade or so.
Sure. So can we expect some more shocks? I mean, if I talk about yesterday, we did see, markets on the downtrend, last evening. So what is the way forward? I mean, can we expect similar volatility over the next few weeks, over the next few quarters?
Yes, Ritika. So a 0.5% movement in the market is no volatility. You are taking people who are investing in the equity market are not coming for a fixed deposit kind of returns. They need a superior returns. So they need to live with a 0.5% here and there, and they can't compound this 0.5% and extrapolation of this trend. So having said that, yes, as I mentioned again, that we are in a very interesting time on the economic front also. And whenever the economic progress happens, if you look at global markets, in the US markets, a trend of 2 decades, 3 decades, the Russell 2000 will outstrip the gains of the S&P. So the broader set of markets is going to do very well with a lot more certainty versus the concentration which has happened in the global markets on the tech side, or maybe a concentration in the Indian markets which would have happened in a few set of stocks when the conditions were not good. But now, to me, the broader markets will do far better.
Sure. So with that, I feel that obviously India's macro story does look positive and is very bullish. we are seeing markets making new highs. But what about the valuations, Manish? What do you have to say about that? Do you think the present valuations are justified?
So on two things, two counts on the macro sides where the tailwind is coming in. So apart from the micro, what the government has set the framework right with all the painstakingly built issues, what they've addressed over a period of time. We also are going to witness the decline of the US dollar, significant decline of the US dollar. And that's the reason you are seeing the huge FPI inflows, which has happened in India in the last 2 months or so. And also just remember this, what most of the people have not maybe overlooked this trend is that there is a failed reopening of China. So it was a lot of expectation, a lot of money was sitting on the fence on the reopening of the China trade, and which failed because the GDP has been quite significantly being propped up over years because of the housing markets in China, which is not happening anymore. So this is a capital which is going to find a new space in India, and they will look forward for the Indian markets. And having said that, if you look at from a valuation perspective, usually I do look at long-term charts on where the ratios of valuations are sitting. And if I have to look at very simple as basic as a small cap indices versus the Nifty indices, you would see that they are not at the extreme lower level and neither at the exuberance level. So they are somewhere sitting in the middle. And I see a lot more room scope to grow in the next half a decade or so. So I don't see any exuberance at this point of time, just because we have seen a sustained 4 or 5 months of reasonably good journey doesn't make any strong case that we have moved into exuberance.
Sure. Bhavin, moving on to you, what do you have to say about the valuations? Do you feel that, the current valuations at which you are these justified?
I think so. Where we are with valuations, when you look at the PE multiples, they are depending on whether you're looking at large cap versus mid cap versus small cap. You might be a bit just a little over the median valuations from a historical range. So not too excessive. Price to book multiples are fairly above the historical range, but I think the overall, that has to be seen in context of return on equity and also the interest rates. And I think with the backdrop of falling inflation, potential for interest rates to moderate, and with the backdrop for strong economic growth that is sustaining, I think one can still accept the value as they are, especially when we look for specific names across the market. Enough opportunity is still there. Sure.
So you believe that there is certainly a very strong opportunity, and investors who are kind of in a fear that markets are making new highs, and that is kind of keeping them away. They should not be doing that, because valuations wise we are certainly at a very, very attractive level, and for sure we will see superior returns getting made from here. Are we right in assuming that?
So, the markets have moved up, right? And as I said, when you look at, for example, price to book, we are, materially above median levels. If you look at market cap to GDP, we are this is definitely above the normal levels that we see for India. So valuations have moved up a bit, but and I think so. Any kind of news can definitely drive a small correction. But when we look across, the opportunity side in terms of companies, there are enough companies out there that one can still buy at a reasonable valuation. So I think, as opposed to saying that the market as a whole, is attractively valued, I think I would say that there are enough opportunities that are attractively valued, and so investors can look for those, as opposed to being very pessimistic about the market because of the overall market valuations.
Sure. So moving on, coming to you, Sumit, ASK Investment Managers largely follows growth style of investing. And if I talk about the last 18-20 months, we did see a lot of good quality growth oriented businesses seeing a lot of volatility and actually generating low returns, for the investors. So what do you have to say about this? Why did we see that kind of volatility in good quality businesses, and what is the way forward? What should the investors expect, who are invested in such stocks or in such portfolios? So I would like to hear from you, Sumit.
See, I must say that you're only partially correct when you say that ASK follows a growth style of investment. See, when you look at businesses, growth is vital. But pure growth in isolation doesn't have too much of a meaning. This growth actually has to be backed by the capital efficiency that that business has, because only then it can be a self-generating growth. So that is what actually ASK looks for: a long period growth, focusing on high ROC, and thereby focusing on high growth in cash flow. That's essential for value creation. Even when we buy such kind of businesses, would value creation be linear? It's not going to be a clear linear line over a long period of time. There are going to be violence in the whole process. But if underlying businesses are continuing to do well, the relevance of those businesses are kind of improving consistently. Are they gaining market share in the marketplace? And that backed with obviously what is the kind of ROC that those businesses are generating. That essentially will create value over a long period of time. And when you look at many of those businesses which may have underperformed last year, but their earnings compounding is continuing. So to that extent, many of those businesses actually became relatively more attractive just about 3 months back as well. And you've seen over last, while 1 quarter is too short a time frame to say anything, but the jump in many of those businesses also have been pretty decent. So, markets over a long period will focus on those value creating principles, and if we continue to focus on those with very significant level of discipline, value creation is actually an outcome, and that is what we keep doing. So to that extent, I would say the way markets have rewarded those businesses, I would say there is an opportunity in that part of the market at the current point in time.
Sure. So what exactly happened? I mean, why did we see volatility in those businesses in last 18, 20 months, because I myself have a lot of my clients, investors who've invested. So what exactly happened? If you can, kind of in a minute, explain that as well.
See, markets have a mind of their own, right? Different points in time, they would look to reward different set of businesses. It's not that only high quality, high growth will make money at all points in time. There will be some businesses which are kind of relatively moderate growth and moderate ROE. They would also kind of deliver certain compounding returns over long period of time. Would that returns be lower in terms of overall value creation? Probably yes, but returns in many a times in those businesses tend to be in lumps. And there are points in time in markets where you see returns coming up in short period of time in those businesses. Right? So you tend to see growth underperforming, value growth underperforming, right? So to that extent, I would say that's the way market behaves. One should not get carried away by looking at a performance of 15 months or 18 months in the marketplace, because market cycles can be significantly longer. It's those principles of investing that make money. When we keep following those, that is essentially the important aspect.
Sure. Thanks. So what, as per you, Sumit, there is a follow-up question to what we just discussed. So what, as per you, will actually, lead the way forward? Do you think whether a pure growth-oriented businesses or stocks will lead the way forward, or maybe value, a value style of investing will lead the way forward? What, as per you, I mean, if we kind of look back at the past trends, where do you see the next, real wealth getting created?
Yeah, we don't differentiate whether it is growth or whether it is value. Actually, what creates value is high growth, high ROC, right? When that backed with pricing which offers margin of safety, right? Growth at any price will not create long-term. I mean, it may create subpar returns over a long period of time, right? But these are essentially the important aspects. So whether one may call that as growth stock or one may call that as value stock, it doesn't matter to us, right? Markets will always record profit growth, cash flow growth, and the relevance of that business over a long period of time. So to that extent, the whole difference or whole kind of discussion that that marketplace encounter with respect to growth doing well or value doing well at different points in time, that's something we generally don't kind of focus on too much. Markets are really bottom up. A business that is doing well will deliver you return over long period. That's the way investing has to be. There are different sort of macro investors as well who would kind of look at those. We are not people who would like to focus too much on saying these as growth, because how do you define growth? People define value as low price to earnings or low price to book, right?
Right.
A business with low ROE logically should have low price to book as well. And businesses over period of time are also changing course. In the past, tangible businesses used to command a lot of value. Today, intangibility has increased dramatically. So the whole relevance of pure price to book in isolation is also losing meaning. So, the whole focus has to be bottom up rather than looking for whether it is a value one or a growth one, or whether growth style will do well or value will do well from here on.
Sure. Thanks. Manish, let's quickly hear more from you on this, value versus growth. Which style of investing you feel will lead the way forward, say over the next 2-3 years? What do you have to say about this?
Ritika, there was one big transition which took place last year globally, where the whole discounting of cash flows for the growth companies was having at a very aimlessly low interest rate cycles. And when the interest rate cycle changed, where the Fed became one of the most aggressive central banker in the world, and the inflation was eating everything. And then the style of the investing changed globally, and the value started doing well because the asset which was put on the table was repriced in a different scenario altogether. But having said that, it is something which will trounce both value or growth over a long period of time is likely to be the growth at a reasonable price. Obviously, a deep cyclical value will have its own shades at some point of time, and even the growth will have its own glory in the shades. But the one thing which will do a sustainable value creation will be growth at a reasonable price, because it sits at somewhere in the intersection of both these investment ideologies. And having said that, if I have to look at today where the macroeconomic scenario is played out, the value will do far better than the growth in intermediate period, unless until the cycle changes, the interest rate cycles globally changes again.
Sure. I think that, yes. So that'll also give the investor community a lot of clarity around this. And moving on, Bhavin, I think my next question is for you. Given the current scenario that we are into, we are seeing markets bringing back the cheer. Investors are they are kind of making up their decisions to reinvest into the markets. Obviously, the last 18-20 months period was times were uncertain. Investors were kind of not finding them attractive, but we've soon seen that kind of attraction coming back, and we are seeing investors moving their money from debt to a lot of equity portfolios. So what do you have to say about the times? What do you think that investors should position their portfolio in the current times? Should they be more inclined towards mid and small caps, or they should have a significant proportion of amount parked in the large caps, especially during the current times when obviously we also talk about valuations which are surely not very low? So what do you have to say about that?
I think India is, Indian markets are a fertile ground for identifying opportunities in small cap. I think if I look at the performance of small cap over whatever period you want to look at, I think they have been amazing asset class to participate in. Obviously, that asset class has higher volatility, and if there is ever any kind of a significant correction, that asset class suffers a lot more. And that obviously is, so investors have to have an appetite for that, for participating in small cap, but the return potential from that asset class remains very high for a number of important reasons. I think one, there are a lot of, our economy is creating some amazing new companies, or companies which were small for a number of years were not getting great opportunities, are getting new opportunities as new sectors are starting to deliver growth, or sectors that were subdued for a number of factors are finding opportunities to deliver significant growth. For example, in last couple of years, we are starting to see huge active opportunities for companies who are involved in creating manufacturing capacity, not just doing manufacturing, but creating manufacturing capacity. So, and then there are many other new sectors also emerging. And then there is an amazing Indian entrepreneurial spirit, that I think continues to drive momentum in that segment. So I would say that even after the recent run-up, small cap segment continues to be a great opportunity, provided one has an appetite for that volatility. Having said that, I think I think investors can balance their portfolio according to their risk appetite, but I think a slightly higher tilt towards a small cap can still be justified, in my view, based on where things are. And I think my observation is that a pure large cap strategy, I think index funds can achieve this basically meet the performance requirement of an investor from that. So I think when we are talking about investing in active funds, the opportunity still is much greater in the small and mid cap space.
Right. No, I completely agree with you, Bhavin, on that. And, because you mentioned about manufacturing as a sector. So this is one sector which I believe is on the radar of every fund manager. Manufacturing sectors, with CapEx, capital expenditure as a theme. I mean, these sectors are on the radar of every fund manager. Why do you think so? That is the case. And you think that these sectors will surely contribute strongly towards the next phase of growth?
Well, I think the reason, one is that both from India's perspective, our government has focused on domestic manufacturing a great deal for a number of years now. And then the whole the events around COVID and other political developments have basically got the countries around the world, the developed economies, wanting to have alternative sources away from China. And so internal push to create stronger manufacturing base and that external demand, I think both are kind of coming together nicely. And as a result, I think we are seeing, when we say manufacturing, it actually is not just about, say, industrial manufacturing, but across a whole range of industries. That I think that opportunity has emerged, and it's not a one-year opportunity. It's sort of a very long-term opportunity to because I think some of the customers are coming to India with a very long-term plans. So I think that is why it is emerging as such an attractive segment to focus on.
Sure. How about CapEx? CapEx as a theme. You see what is the way forward on this sector?
So I think one is that the government, if you look at our budget, the focus has shifted towards asset creating, a spend. The CapEx has given a bigger trust in our government's plans for investments. So I think that's one. And then I think if a company is getting a contract from a foreign customer to supply whichever products, obviously they're going to have to add new capacity in most cases. And so that's also driving the CapEx kind of laid opportunities.
Sure. So I think we covered manufacturing CapEx. Manish, I'll come back to you, with the questions. Apart from manufacturing or CapEx, which other sectors you believe will participate in India's next growth story, or which sectors you believe can be called as the growth catalyst for the Indian economy?
So Ritika, if you see, there are changing shades of the economic architecture every 5 or 10 years.
Right.
Some companies which have waited to bask in that glory for long enough, and then the time comes for those companies. They may not be existing. They may be existing companies or new set of companies which would come in. There is one clear trend which I see today, trend to bet on for maybe next half a decade or so, is the premiumization. So if you look at what has happened is inflation has eaten away the pockets of many of Indians. And one pocket which has not been eaten away, which is with flourishing, is the the premium side of the markets. And that's the reason in every commentary, if you hear about the product upgradations, if you hear about the sale of the premium products, which is doing well and likely to do well. And so to me, the premiumization, wherever there's companies which are able to premiumize their product or which are operating in that segment, are going to do far better than the very value segments. And many of the companies have launched from premium to mass premiums to cater to that economic strata. So that is one theme, irrespective of the companies, which is going to do well. And then it's the job of the investment manager to figure out which company would fit in intersection of the framework, what they are looking at.
Sure. Sumit, how about you? What do you have to say about the sectors apart from manufacturing? Which other sectors you believe will participate in the India's next growth story?
So, I mean, see, I would say the way India has kind of changed over the last few years, while markets may have compounded at almost 13 to 15% over the last 5 or 10 years, but the underlying has changed in terms of the steps that this government has taken with respect to a lot of taxation that it has changed. So to that extent, what we believe is structurally growth is going to be a lot more superior as compared to what it was in the past. So to that extent, the areas that we believe should play out would be India consumerism. It's continuation of what has been happening over the last 10 years, and we believe this story will continue. Think about it. If India's per capita consumption or per capita GDP grows almost 2.5x over the next 10 years, the way overall consumption is going to be massive, and it is going to be at scale. So this is one big opportunity that we believe will continue to play out over the next 10 years. Clearly, finance, banking is another area that will play out. Manufacturing will certainly do well. And when manufacturing does well, it's not only capex or investments related businesses that do well. You start to see capital goods businesses doing well. You see consumable businesses doing well. You see logistic businesses doing well. You see staffing businesses doing well. So it encompasses multiple sectors within it. Right? So I would say I would be doing injustice if I say just one or two sectors that will in the country. I think opportunity is immense here.
So I think with that, we've covered a lot on, the sectors which will contribute towards, the India's next growth story. But let's also hear from you in terms of understanding that obviously the Western world is surely going through, there is a bit of turbulence. Obviously, India has remained resilient. That's the reason, in last 18, 20 months, we did see some shocks, but India was kind of insulated, from all the recessionary fears we saw in the Western world. So where do you see, what do you think, Sumit, where do you see which all sectors can get impacted because of the recessionary fear or those turbulences in the Western world?
See, as you rightly said, India has actually been relatively more resilient from a macro standpoint. So the whole idea is to focus on those domestic oriented businesses, those businesses which are globally linked. We have seen how the growth rates in many of the IT businesses that have actually come down. Commodity prices are down. So global cyclicals, global metal prices, those have taken a beating. So businesses which are globally linked are best avoidable at the current point in time. Those which are aligned to India macro story, those which are aligned to India's manufacturing theme, whether it is domestically or manufacturing for the world as well. Right? Those are the areas where I would believe there are pockets of opportunities.
Sure, thanks. Manish, which sectors, according to you, can get impacted, because of the turbulences there in the Western world?
So any businesses which are external facing, and especially I have a very strong view that US will go for very difficult and choppy times. So the businesses which are offering their services to the consumer discretionary in the US markets are going to get impacted, which is like the bed linen companies or so, where they gained significantly in the times of the COVID. And then maybe some kind of slowdown would occur in the retail and the BFSI segment in the US markets. So the businesses which are facing or offering their services from India to those markets, to the developed markets in that area, would definitely would suffer. And yeah, so that is where, in fact, if you have to look at for the black spots, these are the businesses which can gain a black spots.
Sure, thanks. Bhavin, moving on to you. Which sectors do you believe can get impacted because of the recessionary fears in the Western world?
So recessionary fears is one thing, and actual having recession is another thing, right? So,
Yeah.
but if we do end up with weak growth in earnings, corporate earnings this year in US, it can impact the spends next year. So, for example, the IT sector, obviously, the Indian IT sector can have that impact in terms of slower growth. So that is the one that I think one should also be concerned about, apart from the sectors that Manish talked about.
Sure. Thanks. So, with that, I mean, in continuation to your response, there comes another question from my side. Given that there are turbulences in the international markets, what do you think? Is it a good idea to add US equities, for an investor to add to his portfolio from the diversification sake? Or you think that it can, because as Manish said, that, we may expect more pain, more turbulence in that part of the world? Or, should investors stay away and be invested in the domestic markets only? So what do you have to say about that?
I mean, I think I've always believed that it is worth having exposure to markets outside India. And I think the easiest way to do that is through a US market, because there you not only get exposure to the US companies, and many of them are clearly global players. So essentially you're getting exposure to the world economy, not just US markets. And then there are some leading global non-US companies, whether it's companies from Asia or Europe, they're all listed in US. So it is an excellent portfolio diversification. If you look at the theory of investments and the efficient frontier, your portfolio returns can be a bit higher over time and risk lower if you diversify sort of beyond one market. And I think the other thing is that we haven't reached the point where India's currency has been able to show stability against US dollar from a longer perspective. So till we reach that point, there is that depreciation of rupee also at play. So those factors combined tell me that it is worth having some exposure to US equities. I think the recession, I mean, I'm not an expert on making a call on US recession. I think economy is holding up pretty well, actually. And I think, it is also possible that it sort of avoids a meaningful recession. Although, slower growth is very much on the cards. So in that backdrop, and when we look at the valuation of some of the US stocks, I think they're still available at not excessive price. I think there is good yield, cash flow yield and so on. So I would say some exposure to US equities is still a good idea. And in fact, from a longer term perspective, it is always a good idea to have exposure to US market, in my view.
Sure, thanks. So Manish and Sumit, my next question is to you both. Obviously, we're discussing a lot about the Indian markets. We're also discussing about the US equities, and at the same time, we are kind of talking about creating a resilient and all-weather portfolio. So, from the diversification perspective, which other international market, apart from the US markets, which other markets you think that investors should have exposure to, in their portfolio, so that, it can help them diversify their assets? So starting with you, Manish.
So I would suggest that when you talk about diversification, for me, US is no-go. US tech is a no-go at the moment. The investor runs a risk for any other markets in the world. When you're investing from India home market to the external market, if you just look at in last 1.5 years, 15% of the gain is made by the rupee depreciation. So if the reversal has to happen, which a guy like me would believe that there is a reversal which is going to happen significantly in the next 3-4 years, then you would lose a 10 or 15% in the offshore diversification also. Now, having said that, if one has to build or is inclined to build, then maybe emerging market is an area which one need to get invested into. And emerging market Asia funds is something what need to get built into. And that is going to be a very good tool for someone to build. And maybe emerging market consumption is what something I will be more precise to build as a diversification tool.
Sure. What according to you, Sumit,
So see, I mean, clearly the pockets of growth world over are by far very few. Right? Developed markets clearly don't offer any of those. Whether you think about US, Europe, Japan, rate of growth there clearly is going to be pretty limited. Even China, one really don't know. Right? And we believe that diversification for the sake of diversification doesn't necessarily give you advantage. So to that extent, India itself kind of gives you enough diversification across multitude of business areas domestically and internationally, right? So India should be a large part. But if one were to kind of really get into it, probably some markets in the emerging geographies probably could do well, but clearly the focus has to be India more than international.
Sure. I think we have covered, on the portfolio construction, we've covered on the sectors, we've kind of taken up 1-2 questions on the global investing. There is another question that is largely on the minds of every investor, that is whether they should construct a diversified portfolio, which can actually help them achieve an alpha in long run, or a good concentrated portfolio, maybe a 6 to 8 stock portfolio can help them achieve alpha in long run. So what is your take on this, Sumit? If you can throw some light on this part, because this is one such question that I also get to hear from a lot of my investors out there.
I don't think there is any particular number that one should look at. It's basis one's own thought process, one's own risk appetite, and even investment manager or portfolio manager would have their own thought process of investing. Some would be comfortable investing into 10 businesses. Some would be comfortable investing into 20, 25 businesses. It's a different sweet spot for different manager. So one can't paint everything with the same brush. It has to be sufficient number of stocks which actually give enough diversification to cater to the opportunity that is right there in the marketplace. It should not be too diversified that one start to kind of build a long tail that it starts or it doesn't add too much meat into the portfolio, right? So whether this number is 10, 12, 15, 20, it will vary from individual to individual and manager to manager. But clearly the portfolio has to be constructed in a manner where the right opportunity space is being catered to.
Sure. And Manish, would you like to add more to it?
Ritika, this question doesn't arise if investor knows that he knows those 6 stocks, he should be in 6. If he knows that 1 stock, he should be in that 1 stock. So if they are confused and they're asking this question, then they shouldn't be asking this question next time to you guys. So to me, if someone knows which are those 6 stocks which will create a phenomenal wealth, I would like to know, and maybe everyone in the world will like to know. So it's so difficult to really pin down that these are the 6 businesses and I can see the world far better than anyone else. There's no answer to this question to me. This is not a really very difficult question for someone to answer. Yes, if you can get those 6 stocks, you get those 6 businesses, which will beat every other businesses. There are maybe 600, 700 businesses. And if you get those 6 stocks, which is a 1 percentile of the market right, then obviously they should not be attending this seminar even. So I'm not sure that investors are so educated in this world, which they can get those 1 percentile of the stock. No one gets it right. So they should be very careful and in hearing these conversations on diversification or concentration. It is everyone's individual's risk appetite. So none of us maybe in a panel could have a really great answer to this.
I completely understand. I understand that no portfolio can be defined as the best diversified or the best concentrated portfolio, right? Since we are talking about constructing and building an all-weather portfolio, hence we get, we have investors who want to hear more from the fund managers, and that's why we are in discussion around this. So, yeah, please.
All-weather portfolio is built build across asset classes. That doesn't work on a one single asset classes. You have an asset class diversification. You have the capitalization diversification. That's what a truly an all-weather portfolio is, and something which a family office in Europe would do, which has a generational wealth, and they want to preserve that. If you are, what mode of a wealth creation you are would define concentration, asset classes, and everything. So there's no one straight fit answer which would fit in here.
Sure. So with that, I think we'll have to call it a wrap. Thank you so much, the esteemed panelists, for taking out time on a Saturday afternoon and covering a lot on ground on the all-weather portfolio construction. These interesting inputs from you all has surely given a food for thought for the investors out there. So thank you so much to each one of you, and over to you, Aishwarya.